Hi CA students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decisions. Practical question 13. Unnat Limited is considering investing 50 lakhs in a new machine. The expected life of machine is 5 years and has no scrap value. It is expected that 2 lakh units will be produced and sold each year at a selling price of 30 per unit. It is expected that the variable cost to be 16.5. So contribution will be 13.5 and fixed cost to be 10 lakh per year. The cost of capital of Unnat Limited is 12% and acceptable level of risk is 20%. So this will be useful at the end. We will discuss it later. You are required to measure the sensitivity of the project's NPV to a change in. So we have to calculate the sensitivity of sales price, sales volume, units, then variable cost. Then this is a separate requirement which we will see later. And the final requirement is calculate expected net NPV of the project and give your decision whether company should accept the project or not. Now going to the solutions. First, to calculate the sensitivity we need a base NPV. So we'll find out the base NPV. So the initial investment is 50 lakhs and so the initial investment is 50 lakh and there is no mentioning of ignoring depreciation. So we have to 1 minute. But even though if we calculate depreciation, they have not given any tax rate, so there will not be any impact because tax benefit on depreciation will be the only effect. Depreciation is a non-cash item, so anyway it will not come into our cash flows. If tax rate is given, then we have to consider tax benefit on depreciation, but as of now there will not be any change here. So depreciation we don't need to do anything. In between cash flows 2 lakh which they have given, then multiplied by 30 per unit, 60 lakhs. Then variable cost is 16.5, 2 lakh into 16.5, which will come up to 33 lakhs, and the contribution is 27 lakhs. Fixed cost they've given us 10 lakh per year, so 10 lakhs. Then 17 lakhs will be the annual cash flows. Now going further, we know that the cost of capital is 12%, so we can take annuity factor for the life of the project. The life is 5 years, so 5 years annuity factor will be 3.605. If in case in question if they've given, then we can use annuity factor which is given in the question, but if it is not there, then we can take up to 3 decimals and proceed with the problem. Now 17 lakhs into 3.605 will come up to 61 lakhs 28,500. Now reducing with the initial investment of 50 lakhs, we will get a value of 11 lakh 28,500. This will be the base NPV. Now keeping this base NPV, now we have to calculate the sensitivities. Okay, since they are asking the sensitivity of projects NPV to a change in following parameters, so we can go with the break-even approach. Going with the break-even approach, we have to keep the respective variables as x and proceed with the sum. They have given sales price, which is selling price per unit. Don't confuse it with the total sales. They have clearly mentioned sales price, so sales price will be selling price per unit, and keeping sales price as x, then we will arrive at this 56 lakh 86,900 as the total sales. Now that divided by the number of units, we will get selling price per unit, which is 28.43. Now going further, using this 28.43, then the existing selling price per unit is 30. So 30 minus 28.43 divided by 30, we will get the change in percentage, which is coming up to 5.22 percentage. So the project is sensitive towards sales by 5.22 percentage. Okay, going further, they are asking sales volume. So we have to keep the sales volume as x, wherein we know the contribution is 13.5, so we can directly go with 13.5x minus the 10 lakhs, then into annuity factor, then initial investment, wherein we will get the value as 1,76,812 as the units. Then 2 lakh minus 2 lakh will be the existing units. We will get the sensitivity as 11.59 percentage. Going next, variable cost. So variable cost will be again same, variable cost per unit. 2 lakh will be the units into 30 minus 2 lakh into x. Either we can go with this or directly with the sales minus x also, and we can divide it by the number of units. We are getting a value of 18.065, and the current cost is 16.5, which we are getting a sensitivity of 9.51 percentage. Going next, okay, till now we have found out 3 sensitivities. So towards sales, selling price per unit, it is 5.22 percentage sensitive, and towards sales volume it is 11.59 percentage sensitive, and towards variable cost it is 9.51 percentage sensitive. We can say it is most sensitive towards sales, as a reduction of just 5% of selling price per unit will make the project unacceptable, will bring the NPV to 0. Going ahead, we will see the last requirement. On further investigation, it is found that there is significant change that the expected sales volume of 2 lakh per unit, 2 lakh units per year will not be achieved. The sales manager of the Unnat Limited suggests that sales volume could depend on expected economic states, which could be assigned the following probabilities. So they are bringing in scenario analysis into the sensitivity analysis question. So they are telling this part is specifically scenario analysis question. They are telling the entity will not be able to achieve 2 lakh, but they have a probability that based on the state of economy in these 3 conditions, and we have the probabilities, we can arrive at an expected annual sales unit. Using that, we have to calculate NPV. So the expected net present value we will find out directly by, first we have to find out expected annual sales unit. So in our case 1,75,000 into probability of 0.3, and then 2 lakh into 0.6, 225 into 0.10, and summing of that we are arriving at a value of 1,95,000, which is nothing but the expected annual sales unit. Now using this expected annual sales units, we'll multiply with the contribution and then reduce with the fixed cost, then multiplying with the annuity factor for 5 years of 12%, then we'll arrive at a NPV of 8,85,163. Now going further, so the expected net present value will be 8,85,163. NPV in worst and best case scenarios we can find out by taking the worst case as 1,75,000, since if the annual sales units is less, then it will be the worst case, and the more the number of units we sell, that will be the best case, which is giving a NPV of negative 88,188, and in best case it is 23,45,000. Now going further, since they've given acceptable level of risk as 20%, but as we can see, the possibility of negative NPV is 30%, right? The possibility of negative NPV is 30%. The poor sales of 1,75,000 units, wherein the NPV will be negative 88,000, and the possibility of positive NPV will be 70%. In normal 60%, and in good scenarios it is 10%. Since our acceptable level is just 20%, but the possibility of negative NPV is 30%, the project should not be accepted. As if this word acceptable level of risk is not given, then we could have said that there is a possibility of 70% of getting a positive NPV, then we can go ahead and accept the project. But the firm's acceptable level of risk is just 20%, and there is a possibility of negative NPV of 30%, hence we should not accept the project. So the same has been given in ICAI solution also. There are 30% chances that the rise will be a negative NPV and 70% chances of positive NPV. Since acceptable level of risk of Unnat Limited is 20% and there are 30% chances of negative NPV, hence project should not be accepted. Thank you.